By now, everyone should know the story about the rise of emerging markets. But one of the questions facing investors is how should they go about getting exposure? And how much exposure is required when the investors live in a country considered to be at the forefront of emerging markets? Andrew Rumbelow is the Chief Investment Officer of Sanlam Multi-Managers International, and he joins us from our Cape Town studio to discuss this question. Andrew, thanks for joining us. I just wanted to obviously talk about, lead us through how investors in emerging markets like South Africa make a decision around allocating money to emerging markets in general, and what specifically we should consider when we do that.
Good afternoon, Warren. Yeah, thanks very much for having me on the show. Warren, our view over the last couple of years has changed a little. I think most South African investors, and particularly institutional investors as well as retail rather, have held the view that South Africa is an emerging market, and so when we have invested internationally, we've tended to focus on the developed markets of the world. And a lot has changed within emerging markets over the last decade. And we started asking ourselves some questions about whether or not us investors sitting out here in South Africa, whether or not we aren't missing out on a couple of opportunities. And just having gone through our research, we've come to the conclusion that we think that investors in South Africa should seriously be making or asking themselves the question, do I have an appropriate allocation to emerging markets within my portfolios? And if not, should I be looking to try and increase that allocation? And there are a couple of avenues open to investors to consider if they arrive at that conclusion. Just to sort of share with you some information in support of that view. I mean, we all know that emerging markets, the IMF estimate is roughly that 40% of global economic activity at the moment can be ascribed to emerging and frontier markets. On a purchasing power parity basis, that is estimated to be about 50%. And that's only going to grow in the years to come on the back of higher economic growth rates in those emerging markets. Corporate governance in emerging markets has improved substantially. The balance sheets of governments in emerging markets are in a far better shape than the balance sheets of developed market countries. And the list goes on. The fundamental reasons why one should be making those allocations to emerging markets in our view are there.
Andrew,
and we haven't
just to come in here, Andrew. Just to come in here, I mean, I was speaking to Mark Mobius from Franklin Templeton a few weeks ago, and he also said a similar thing to what you said. Investors should be considering an exposure to emerging markets in the region of what the MSCI world exposure is to emerging markets. But just within the context of let's say the retail investor at the moment, we hear different things from wealth managers and financial advisors talking about perhaps taking 20 to 30% of one's portfolio offshore. What are you saying in terms of, say, a 30% of an investor's portfolio offshore? How much of that should be in emerging markets? Should about 40% of that then be in exposure to emerging markets in both the fixed income and the equity market?
Well, if we chat about equities for a second, if you look at the MSCI All Countries Index, so that's an index that incorporates both developed and emerging markets. The emerging market countries in that index make up about 14% at present. Now, right now, we would argue for a higher weighting than that. So, probably in the order of about maybe 20%. And that's really on the back of both that longer term secular outlook that I was referring to earlier on, but also right now that the valuations of emerging markets as a whole, in our mind, look attractive relative to developed market equities.
Just in terms of that, getting that exposure, you talk about there's different ways that we can do that. Often we hear from fund managers in South Africa that talk about getting emerging market exposure through developed market stocks. So if you buy a General Electric, for example, or an IBM in New York, they've already got exposure to emerging markets. What's your favorite method of investors actually getting that exposure? Should they go direct into emerging markets from a geographical basis, or should they look across instruments in a bit more of a broader context?
Yeah, I think the answer to that is dependent on the time and effort that they have to focus on the question. Without a doubt, a lot of companies that are listed in developed markets of the world have a substantial portion of their revenue and profits emanating from emerging markets. Our concern is that that potentially doesn't exploit the entire opportunity set out there. There was a really interesting article in The Economist towards the back end of last year that indicated that there are over 1,000 companies that are domiciled in emerging markets that have a revenue, per annum revenue in excess of $1 billion. Now, a number of those are South African entities, but there are hundreds out there in other parts of the world. Now, if you're investing in the likes of the Procter & Gamble's and the Nestle's of this world, there are another 1,000 companies out there, that you're potentially not investing in. And we think that there may be a lost opportunity in that. So if we come back to given that there is this opportunity out there, how should we take advantage of it? I think if you're unable to spend some time and effort in looking into this, yes, then gaining that emerging market exposure through an astute fund manager who's invested in those Procters & Gamble's and Nestle's, etc. of this world, that is definitely a way of getting it. An alternative way, if you can spend a little bit more time looking at this, is going to your global fund managers and asking them whether they have products that incorporate a large allocation to emerging markets. And those would be typically products that are benchmarked against all country type indices, as opposed to the developed market indices that South African investors are usually invested in. And then for those who definitely have some time and effort, then making an explicit direct allocation to an emerging market investment, equities or bonds. One can go and looking at choosing a specific emerging market fund run by an international fund manager, or perhaps even a local fund manager. There are one or two here based in South Africa who offer these products now.
Andrew, just in terms of your job and the portfolios you run as a multi-manager, you go and look for third-party investment managers, as I understand it. I'm interested to find out, where are you finding the best emerging market managers to handle either equities or fixed income portfolios for you? Are they in the emerging markets, or are there a lot of good managers in the developed markets as well?
Yeah, I think the managers that have got the most extensive track records tend to be sitting in the developed markets of this world, and obviously, although past performance comes with all the warning signs about not placing too much reliance on it, any investor does look at that to give them some kind of steer as to how successful a manager has been at the past. So in the equity space, European-based managers tend to hit quite high up on the radar as far as emerging market equities go. On the emerging market bond side, that's both European and US-based managers that we've come across. But as I mentioned earlier on, in the South African equity market, there is a fund manager that has built up a 5-year track record in running an emerging market equity fund that has done exceptionally well, delivering returns well in excess of the benchmark. And they've definitely pinged on our radar, and we've spent some time looking at them. And in fact, one of our larger institutional clients has actually recently made an allocation to that manager.
Just in terms of the split between emerging market equities and fixed income, Andrew, what would you suggest to investors when they think about that? I mean, should it be even, or do you favor equities at this point?
Right now, we definitely favor equities. If you look at the valuations of emerging market equities relative to developed market equities, things look quite attractive in the favor of emerging market equities in our view. It's looking at things like price to earnings ratios, price to book ratios, on both a historic as well as on a forward basis. If one looks at the fixed income markets, Emerging market fixed income had quite a nice rally towards the back end of last year. And so the spreads that emerging market bonds are trading at over and above developed market bonds are now quite close to their all-time lows. Now, obviously, one must be careful about comparing the current situation to the past, because as I mentioned at the outset, the countries have changed quite substantially. But we would be a little bit cautious in making a significant allocation to emerging market fixed income at this stage, given the current pricing of it.